Hello, and welcome to this video on how to reformat financial statements. Reformatting financial statements is a really important step in financial statement analysis because it allows us to better understand the operating and financing activities of the business. That's going to be helpful because operating activities are what actually helps us create value in our firm, while financing activities are distributions of value. So, we're going to be reformatting the income statement and the balance sheet. And reformatting involves us looking at each account on the income statement, each account on the balance sheet, and deciding if an account is a financing or a operating activity. So how do we determine if something is a financing or operating? Well, our rule of thumb to help us remember is if there is interest associated with the account, it's likely going to be a financing activity. So if I go to the bank and borrow some money, I'm going to have a liability for my borrowings. And those borrowings have interest associated with it, so that would be classified as a financing activity. And that makes sense because when we go to the bank to borrow money, we know that's partly due to financing our business. Okay, so borrowing money from the bank, we have to pay interest on it, it's a financing activity. Whereas if I look on my balance sheet and see an account like inventory, there's no interest associated with inventory, so that would be classified as an operating activity. Again, it's sensible. We know our operations are we have to buy and sell goods, so inventory are part of our operating activities to actually generate returns for our business. So to do our reformatting, we need to remember some basic accounting identities. We need to know that the assets last year, so T-1 refers to time period -1, so assets last year equal to our liabilities last year plus owner's equity last year. Okay, so it's the balance sheet equation, assets equals liabilities plus owner's equity, but T-1 subscripts are referring to last year. Then this year's assets in time T, so this year, assets equals liabilities plus owner's equity. Now, how do we get from one balance sheet, last year's balance sheet, and understand the changes to this year's balance sheet? Well, the owner's equity this year is equal to owner's equity last year, plus any comprehensive income we earned, minus any dividends that were paid out, plus any change in outside interests. So this is kind of what you learn about in accounting or introductory accounting when you learn how to create financial statements. To get from one balance sheet to the other year's balance sheet, we have to take into account the profits the firm has earned and the changes in the retained earnings and dividends, those kind of things. So owner's equity last year, plus our profits, minus any dividends we've paid out, plus any changes in outside equity interests. So comprehensive income, just as a recap, if you're not familiar with the term, comprehensive income is different to your net profit. Comprehensive income includes other comprehensive income items, which are things that influence the firm's ending equity balance, but do not influence the revenues or expenses on the profit and loss statement. So other comprehensive income items are things like foreign currency translation gains or losses, cash flow hedges, things to do with your pension plans, gains and losses. Other comprehensive income items show up on the comprehensive income statement. They influence your equity balances, okay, but they don't influence your revenues or expenses on the profit and loss statement. Okay. And in this formula here, when we've got owner's equity this year equals owner's equity last year plus our comprehensive income minus D, that stands for dividends. In this specific context, when we're talking about dividends, we're referring to net payments to shareholders. So we're including both flows in and out of the business. So when I pay a dividend to a shareholder, that's part of dividends, but also if the shareholder gives the business more money, so if the shareholder's buying more shares, that would be a negative dividend. So it's not just the payment of dividends, but it's net payments to shareholders. So that includes all contributions by and distributions to owners. Dividends, share-based payments, share buybacks, all those kind of transactions are included in this little term here. Okay, and change in ownership interest outside ownership might be a small part in some firms' balance sheets. Okay, so this is a recap of what we know from introductory accounting, how the balance sheet and income statement go together to create the next year's. So when we go through the reformatting process, we've got 4 steps here. The first step here is we're going to be looking at our statement of changes in equity, and we're just going to be identifying the different amounts, the comprehensive income, the net payments to shareholders, and any change in ownership interests if there are any. Okay, we're going to just make sure that our equity and profit and loss statement items balance out. So equity this year is equal to equity last year plus comprehensive income minus dividends, the net payments to shareholders, plus any changes in ownership interest. The second step, we're going to look at our balance sheet, and we're then going to reformat the balance sheet. We're going to look at each account, figure out if it's operating or financing, and we're going to reclassify the balances. We're then going to have what's called net operating assets minus net financial obligations equals equity. Assets minus liabilities equals equity. After we reformat, net operating assets minus net financial obligations equals equity. We also split the profit and loss statement into operating and financing. Normal income statement, revenues minus expenses equals profit. After we reformat, we have net operating profit after tax minus net financial expense after tax. That gives us our net income. Then step 4, we calculate free cash flows and check that they equal. So let's look at these steps in a little bit more detail. Here we've got an old financial statement from Qantas in 2015, and this is the equity part of their balance sheet. And we can see at the end of 2015, they had total equity of $3,447. And at the end of the prior year, 2014, they had ending equity of $2,800. So their owner's equity this year is equal to $3,447. And it's equal to last year's owner's equity from the balance sheet here, plus any comprehensive income minus payments to shareholders. So let's have a look at their consolidated statement of changes in equity. In the statement of changes in equity, it tells us the total comprehensive income or loss for the year, and it gives it 558. And it tells us the total contributions by and distributions to owners, which we're using the term D for dividends. And they've got a minus 19 payment to their shareholders in this case. Qantas also had some ownership interest changes equal to 4 during the year that we need to take into account because that influenced the change in equity balance. So our formula, this year's equity is equal to last year's equity plus the comprehensive income, which we just got from the statement of changes in equity, minus the minus payments to shareholders, plus the change in ownership interest. Okay, let's move on to step 2 in the process, which is reformatting the balance sheet. To reformat the balance sheet, we have to classify every account as either an operating or a financing account. On a traditional balance sheet that you're familiar with, you know that assets minus liabilities equals owner's equity. What we're going to do when we reformat, we're going to classify all our operating activities together, and we're going to classify all our financing activities somewhere else. We're going to have some different headings. We're going to then have net operating assets minus net financial obligations equals owner's equity. So the steps to follow look like this. Number 1, you identify which assets and liabilities are financing. And our rule of thumb is anything with interest would be classified as financing. Anything that doesn't have interest will be classified as operating. So identify all the financing activities that have interest and calculate your net financing obligations. Then every other account, we classify our net operating assets. Finally, we just confirm that owner's equity equals NOA minus NFO, that we haven't missed an account and the balance sheet still balances. So here's a really simple balance sheet for some practice. We've used very obvious heading names to really make it clear what is an operating activity, what's an operating liability, and likewise for financing assets and liabilities. So on this balance sheet, we've got some operating assets. We've got marketable securities, which would be maybe we've invested in the bond market. We've got some spare cash that we've invested in some bonds. They'll be paying interest. We've got some operating liabilities. We've got bonds payable. We have to pay interest on the money we've borrowed. So operating assets and operating liabilities, the name gives it away. They're going to be classified as operating accounts. Marketable securities and bonds payable both have financing parts because they have interest associated with it. So we're going to reformat the balance sheet. Here's our reformatted balance sheet. We start off with our operating assets, our operating liabilities. Assets minus the operating liabilities equals net operating assets, or NOA. Then we come down to our financing section. The marketable securities were a financing asset. We own that. The bonds payable is a financing liability. We owe people some interest. So our financing assets and our financing liabilities are here. And for most businesses, they have more financing liabilities than financing assets. So I'm going to call it net financing obligations. That means I'm expecting us to owe more than we own. And I've taken the liability minus the financing asset to get the NFO of 4,400. My net operating assets minus my net financial obligations still gives me that same book value of equity, 4,500, which is the same as in my balance sheet before I reformatted it. So my balance sheet still balances. We don't change the equity balances. We're just reclassifying some of these accounts into operating up here or financing activities. Okay, so we've now reformatted a balance sheet. Let's now learn how to reformat the profit and loss statement. In a similar way to what we did with the balance sheet, we're going to go through every account on the profit and loss statement. We're going to look at every revenue and expense item and classify if it's likely to be an operating or a financing account. On a normal profit and loss statement, you have revenues minus expenses equals net profit. After we reformat, we're going to have some different headings. We're going to have net operating profit after tax, or NOPAT, minus net financial expense after tax, and that equals net profit. So our overall profit number is going to stay the same. All we're doing is reclassifying the accounts into different groupings, whether they're operating or financing accounts. So to reformat the profit and loss statement, there's 6 steps that we have to follow. Again, we're going to start with the financing activities first. We're going to classify any account that has interest associated with it as a financing activity. Once we've grouped all those financing activities together, we're going to look at our financing revenues and our financing expenses, and we're going to calculate our net financial expense. After we've calculated our net financial expense, in step 2, we're going to adjust this net interest expense to take into account the fact that there's what's called a tax shield or a tax shelter. When a business borrows money from the bank and it has an interest expense, that interest expense is tax deductible. So the more interest expense you have, it will overall lower your profitability and it will lower the amount of tax you have to pay. So financing your operations with interest-bearing financing accounts will create what's called a tax shelter or a tax shield, and that will overall lower the amount of tax you have to pay. So step 2, we're going to adjust the net interest expense for the tax shelter. So we're going to calculate from step 1 our net financing expense. Then we're going to reduce that amount by the tax shield to calculate a net financing expense after tax. Then step 3, all the other revenues and expenses are going to be operating activities, and we're going to calculate our operating profit before tax. We then have to minus off tax expense the business has, plus the tax shelter to get net operating profit after tax. Finally, we then see that our net income or our net profit is still equal to NOPAT minus NFE-AT. It's the same net profit figure as before we reformatted. So here we have an example of a very simple income statement. It has sales revenue and operating expenses. Then it's got some interest revenue and interest expense. So we go through and classify these. Sales revenue and operating expenses, there's no interest associated there. They're going to be operating activities. Interest revenue and interest expense, the word interest is there, it gives it away. They are going to be financing activities. So we're going to start with this section of our profit and loss statement, and we're going to look at our financing activities. So here we have a reformatted profit and loss statement. And as I just mentioned, when we're creating this, we will want to start with the financing activities first. So in our profit and loss statement, we had interest revenue and interest expense that we classified as financing activities. When I reformat my profit and loss statement, I'm going to start with my financing activities. So I've got my interest expense and interest revenue here. The interest revenue is 548 and the interest revenue is 108. So the difference between them, I've got a net financing expense of 440. So overall, I've made a financing loss of 440. That is, my interest bill on a net basis is 440. That's going to lower my profitability. And because interest is a tax deduction, it's going to reduce my tax bill. I multiply this 440 net finance expense by the Australian company tax rate, which is 30%. And that gives me what's called the tax shelter or tax shield. Because I have a $440 net financing expense, it reduces my profit by 440, which means it would reduce the amount of tax I have to pay by $132. So I can then calculate my net financing expense after tax, the NFEAT, which is my net finance expense minus the tax shelter, and I get 308 as my net financing expense after tax. So now that I've calculated my financing activities here, I then go up to the top and deal with my operating activities. Sales revenue and operating expenses were both operating activities. I can calculate my sort of profit here of my sales minus my operating expenses. Then if I flick back here, I can see the business had a tax expense of $424. That was the overall tax expense for the business. But my financing activities made a loss and they had a tax shield or a tax shelter. So here, when I'm back on my operating activities, I've got this profit that I need to pay tax on. My tax expense overall was $424, but my tax on operations would have been higher if I didn't make that loss on my financing activities. So my tax on operations would be the tax expense plus the 132 tax shelter from down here, which gives me an overall tax on operations of 556. So my sales revenue minus my operating expenses minus my tax expense plus tax shield gives me NOPAT, net operating profit after tax, 1,676. I can then minus off my net financial expense after tax to get my net income of 1,368. There was other comprehensive income of 10, so my comprehensive income is 1,378. I go back a slide and I see my net income and my comprehensive income have not changed. All that has changed is I have reclassified the operating and financing activities. And most importantly, the most difficult step to remember is my tax on operations include the overall tax expense plus the tax shield. So with all that done, you've now reformatted a profit and loss statement. If you study finance, you might learn how to reformat a cash flow statement. However, it's not necessary to go through and reformat a cash flow statement. Although it's possible, you separate all accounts into operating and financing. However, there's a bit of a shortcut. If we've already reformatted our balance sheet and our profit and loss statement, we can just use these two formulas to essentially figure out the free cash flows of the business. The free cash flow generated by operations is free cash flow is equal to NOPAT. Net operating profit after tax was from our reformatted income statement. We then minus the change in NOA. Net operating assets was from our balance sheet. And a change in NOA means the current period's net operating assets minus the previous year's net operating assets is change in NOA, plus any other comprehensive income. We could also do it a different way. We're going to get the exact same answer, but a different approach. Free cash flow spent on financing. Free cash flow is equal to net financial expense after tax. That's our interest from our reformatted income statement, minus the change in net financial obligations, NFO, which is from the balance sheet. And the change means the current period's NFO minus the previous period's NFO, plus any dividends, which means net payments to shareholders. We figured that out in step 1 of the process, minus any change in. So with these two formulas, they've got to give you the same free cash flow. They've got to balance out. It's two different approaches of getting the same number. We do both just to check that we haven't made any mistakes along the way. It's the equivalent of reformatting a cash flow statement. Okay, so to make sure we can do our free cash flow calculations, we need to calculate our equity. So our equity in the current period we can get from the balance sheet was $4,500. Equity from the prior year's balance sheet was $3,600. The comprehensive income for the year was from our income statement, $1,378. So to make it all balance, we can figure out that the net payments to shareholders would have been $478. That's assuming there was no other changes in ownership. So our free cash flow equals NOPAT from our reformatted income statement, minus change in NOA from our reformatted balance sheets, plus other comprehensive income of 10, gives us our free cash flow. We can do it the other way. Net financial expense after tax from our reformatted income statement, minus change in NFO from our reformatted balance sheet, plus the dividend, which we just calculated up here was 478, minus change in ownership interest, which aren't in this question. And we get the same free cash flow using both methodologies. So we can be reasonably comfortable. We haven't made any big mistakes here. So a bit of theory or a bit of conceptualization of what we've just done. We've just split a firm's profit and loss statement and balance sheet into the operating and financing activities. And we know that's going to be important when we do financial statement analysis. And if we think about what we've just done in sort of more physical sense, When a business engages with their customers and suppliers, that's going to influence their net operating assets. So when they're actually buying and selling goods. When a business engages with their banks or their shareholders, that's going to influence their net financial obligations. So when they go to the bank and get money, or when they have dealings with their shareholders, all this are financing activities. So we've just separated the operating and the financing activities, and they deal with different parts of the business. So when we think about the operating side of the business, our operating revenues minus our operating expenses gives us NOPAT. Then our NOPAT minus any change in our operating assets gives us a free cash flow. Or if we think about the financing side of the business, our free cash flow is equal to our net financial expense after tax. Essentially, that's the interest we've paid, minus any change in our outstanding debt, the net financial obligations, plus any payments to our payments to shareholders. Okay, and that gives us our free cash flow from financing activities. So we've now reformatted the financial statements. The first time you do it, it takes a little bit of time just to go through the process and learn where everything balances. And you might come into some common mistakes. So common ones, if your free cash flow formulas don't balance, if your balance sheet doesn't balance, if your profit and loss statement's not giving you the same profit as on the normal profit and loss statement. The most common mistake is you might have just simply missed an item that's on the financial statements and you haven't transposed it over when you've done the reformatting. So make sure you go item by item when you're doing the reformatting. Everything that's in the original statements has to be in the reformatted statements. You're just changing the headings around. Another common mistake is when you do the profit and loss statement, remember you have to split the tax expense into the financing and operating section. You have to calculate that tax shield. When you're calculating the net payments to shareholders, remember we use the term D and we call it dividend, but it's not just the cash dividends that are paid out. It's all the transactions with the shareholders. So for example, if the company has sold shares during the year, that would be called a negative dividend because they're actually receiving money from the shareholders rather than paying it out into a dividend. Okay, so don't get confused with the dividend terminology. It's net payments to shareholders. And another common mistake is just getting signs mixed around. Make sure you're consistent in how you do things. Whether you keep all numbers as positives and you know which ones are assets and liabilities and what needs to be plus or minus, or if you keep your expenses as negative numbers, as we did in this example, as long as you're consistent, that's what matters. For example, I used the term net financial obligations. For most businesses, they have more financial obligations than financial assets. So I expressed net financial obligations as a positive number. It's completely possible if you want to do it, you could have your liabilities as negative numbers, okay? But you've just got to be consistent along the way. And finally, if you just make a mistake of misclassifying, say a bank loan and you classify it as operating, all the formulas will still work. Your reformatted statements should still balance out and your free cash flow numbers will still balance out. So just because everything works and balances doesn't mean you haven't made a classification error, but making a classification error on its own won't cause any of these problems. So just be careful when you go through and check if you do have any errors along the way. So in conclusion, firms create value when they earn a return higher than their cost of capital. And firms are likely to earn a return higher than their cost of capital only from their operating activities. So we've just reformatted the financial statements so we can get a much better idea of what are the firm's operating versus financing activities. Because the financing activities, they might influence the return on equity, but they're not going to influence the actual value creation and drive share price growth. So reformatting financial statements allows us to learn a lot more about the firm, and it's really going to help us move forward with our financial statement analysis. Thank you.